Dr. Fawzi Abou-Chahine, thank you very much for joining me today on this week's episode of FI Funding Updates. What are innovation loans and how do they fundamentally differ from grant funding?
This is a great question and one I get asked all the time by my clients. The fundamental difference is that a grant you do not need to pay back, whereas a loan you will have to pay back the principal and the interest. The innovation loan from Innovate UK is a below market rate interest rate, so it's a commercial advantage rather than going to, say, a private bank, but you still will have to pay back that loan. What it allows you to do is get cash up front quite quickly and then pay it back in a time of your choosing while you commercialize.
Now, why should UK businesses consider innovation loans in 2026 rather than relying solely on grants or internal funding?
So there's a couple of reasons for this. Number one, the availability of grants has been a little inconsistent and knowing when it's coming can be a challenge. The other thing is that you always need to look at the wider capital funding strategy. So equity has also been a little hard to come by and it's also expensive. So given those two are not always consistent, debt is a really good way to secure fast and relatively affordable finance.
And what type of companies are best suited to innovation loans and who should avoid them?
So for a loan, you have to pay back the principal and you have to pay interest. So ideally, companies which are generating revenue or at that early stage of generating revenue would be ideal for the Innovate UK loan scheme. You can be a pre-revenue company and still apply, but what you need to demonstrate is that you have enough confidence in your revenue projections to, at the very least, pay for those interest coverage.
How has demand for innovation loans changed over the past 2 to 3 years, and what is driving that shift?
Yep, very much. The availability of capital has been driving companies towards debt. If you think about private equity, venture capital has focused their investments into a few deals. So total investment has gone up, but the availability and number of deals has gone down. And as a consequence, companies are looking for alternative forms of funding, and debt finance has been a big motivator.